We're back together, everybody. Lanny and Bert, the Diplomats, in person.
Too sweet.
Yeah, representing the swag here, the Dividend Diplomat sweatshirt, hooded version, crew neck. Lanny, you got the coffee mug, don't you?
Got the crew neck going. Got the coffee mug blazing. Yeah. Coffee's poured. Dividend investing is here. We're about to dive into another dividend stock. Ain't that right, Bertie?
That's absolutely right. So while you're listening to us, please make sure you subscribe to our channel below. Give this video a thumbs up and check out the swag store. I know we're joking, but these are actually pretty comfortable. But that's not why we're here today. This video, everybody, we are going to talk to you about an undervalued dividend stock, and not just an undervalued stock compared to the market, a stock that is significantly undervalued compared to its peers in the industry.
That's right. You know, you probably saw our last video talking about two undervalued dividend bank stocks to buy, as banking really is an industry right now in this overvalued stock market that is still showing signs of undervaluation. Again, we talked about two smaller banks in that $1 to $2 billion range. But now, Bert, it's time to kick it up to the $1 trillion range.
Not just 1 trillion, but $2 trillion.
$2 trillion, B?
Yeah, and some of you asked about this bank stock in the comments below, and we start looking at it. My wife owns this in her portfolio, so obviously I'm interested in looking at it. Lanny, who are we talking about today?
We're talking about the baddest, the biggest. No, not the biggest bank, but we are actually talking about Citigroup. Ticker symbol C.
What was it, Lanny? Was it with the Cavs?
The Cavs, the big double C, Cleveland Cavs, baby. Let's
That's
go.
Right. That's a throwback reference.
Vote for Jared Allen for the All-Star game. Small plug for the Cavs, baby.
Yeah, you know, to help the Cavs out, we're going to put a link in the comment section to the NBA All-Star voting here.
Let's do it.
All right, everybody. But what exactly is going on? Lanny, what are some of the major storylines here that are impacting the banking sector? I think there are a few that are just catching the attentions that are causing some turbulence for the industry as a whole.
Yeah, for sure. So first, you know, the Federal Reserve is more than likely going to have a few interest rate hikes this year. Some predicting 2, some predicting 3, some predicting in March, some predicting in June. The probability, though, is that interest rates will be going up. So that is either a good or bad thing for banks. Obviously, banks more than likely can start adjusting their rate if they're tied to the prime rate. Obviously, new lending rates going forward should go up, but that also may increase the borrowing or deposit interest rates. But we all know the big banks have crappy savings interest rates, so I don't see those moving at all.
They're flushed with deposits there, so there's nothing that's going to move the needle in terms of deposit rates, because they're still struggling to put those deposits to work. So if you have a lot, you're sitting there, you're not going to just raise up the interest rates to attract more deposits. You want to get less deposits, or you want to take that into lending. So yeah, why would you raise your interest rate if you are a large bank at this time?
No, exactly. Banks are sitting on probably the most deposits that they ever have. You know, savings is actually way up for individuals, obviously through COVID. A lot of pent-up demand, limited supply due to the supply chain issues. So there's not as many products or goods that people are spending money on, as well as limited travel or experiences that they're also spending money on.
Yep, and inflation continues to impact as well, because that's obviously driving some of the analysis done by the Fed for the interest rates. It's also going to impact the consumer spending habits here once the student loan repayments start to, whether it's May or into the future. Who knows when that's going to happen, because it keeps getting kicked out. How's that going to impact loan performance? How's it going to impact the personal loans, credit card charge-offs, all that stuff that is fresh on the mind. So these big banks and all the other ones are closely watching the news on a daily basis to see what's happening in the economy.
You know, in Citigroup, you probably remember they, you know, we're going through some of the Fed stress tests back during COVID. Obviously, they're fine. They've passed. They're here. They persevered. You know, as of this video, here we are. It's January 14th. Is the stock price close? And they're trading at just under $67 per share at $66.93.
Yeah, that's right. In some city-specific news, they just released their earnings, and just a few notable items from there from the dollar perspective is their return on assets nearly doubled, and so did their return on equity. So they are earning more. Their net income grew, obviously, during the last year, which increases those two metrics that are key as you're evaluating banks. We typically like to see ROA above or near 1%, and what ROE is, the usual is like 10%, Lanny. Is that the metric that?
Yep. You want that baseline ROE of 10%, and you want that baseline ROA of at least 1%. So they're making headways to be over that hurdle. I would imagine that this year they're going to fly over the 1% ROA for 2022.
Yeah, and at the end of the year, their ROA was at 0.94%, up from 0.5 the previous year, and the ROE went to 10.9%, up from 5.7.
And, when we look at the Diplomats stock screener metrics, we'll obviously look at the price to earnings, the dividend payout ratio, and dividend growth, but we'll also dive in not just the dividend yield, but also the fund banking metric to find undervaluation, which is the price to book value.
So let's jump right in here with Citi. As you said, their closing price was $66.93. Forward earnings per Yahoo Finance average analyst estimate are $7.76. That gives you a PE ratio of 8.63.
Pretty similar to Dimeco, the DIMC bank that we reviewed in our last video. So again, showing really strong signs of undervaluation. Instead of going into that second metric, we're going to talk about the price to book.
Yeah, let's slot that one up in here. Remember, as we said, we like price to book to be above 1x, below 1x, and that's where we see the true signs of undervaluation. Both the stocks we looked at last time with LCMB and Dimeco, I think LCMB was right around 1. Dimeco was in the 0.8s, I believe. Does that sound about right? Fairly
low, below 1.
Yeah.
So really you're taking the share price that's trading out on the market. Again, that's $66.93. And then you're dividing it by the shareholders' equity divided by the number of shares outstanding to get what the base book value is from a balance sheet standpoint.
Yep. So when we look here at Citi, their price to book ratio is 0.73x.
That's a joke.
So that's why.
Hey, you take it easy, bro. That's a joke.
Hey, don't tell me to take it easy. Tell Citi to take it easy, because that is a very low price to book ratio. Man. And that's why we said in the intro, they are a screaming undervalued bank stock compared to some of its peers. I mean, JP Morgan's price to book is 1.5 or higher? Like
a little higher.
The other large banks are significantly higher than Citibank.
So, going into that second metric, we want to know how's that safety and the dividend look, and also possible future dividend increases. Because Bert, when's the last time they've increased that dividend?
It was in July of 2019. What was interesting is bank stocks, we talked about this last year, after the Fed gave banks permission to start increasing their dividend and share buybacks to shareholders after the pandemic, after they went through the stress test and made sure the balance sheets were looking great. Citi was the only notable bank that did not increase the dividend. Some said it was because their yield was already higher than many of the other peers, that we'll get to when you see the bonus metric. But also, they're going through some transition that we're going to talk about after we get through the stock screener that may be impacting the decision as they go through a reorg.
Citigroup.
Yeah.
Citi Solo.
Yeah.
Solo Dolo.
But, okay, so they haven't increased their dividend, but their 5-year average dividend growth rate is 44%. And that's because if you look back at their dividend history, at the early part of that 5-year history, they were increasing that dividend hand over fist coming out of the post-financial crisis. When the Fed let them restart increasing that dividend post-financial crisis, they were just pumping out cash to shareholder. It obviously slowed down in 2020, and that's where we are today.
Yep. And to talk about the dividend payout ratio, right now they pay a nice quarterly dividend of about 51 cents per share per quarter, or 204. So again, the payout ratio is only 26%. So I agree, Bert, dividend growth should be resuming for Citigroup.
Yeah, my bad, everybody. I didn't realize we just skipped metric 2 there. I got so hyped up on dividend growth.
We went start calling you Tito. Hey, Skipper.
Yeah, we went 1-3-2 there. We're changing up the lineup. Let's see how it goes.
Now, to get into that dividend yield as the bonus metric again, the yield is actually 3.05% as of the recording of this video. So over 2 times the S&P 500. Pretty much higher than most of the larger banks out there. Again, we're talking JP Morgan, et cetera, et cetera. So you're getting an above average dividend yield with potential for strong dividend growth in the future.
Let's actually summarize these metrics here. I think let's get them in the right order this time, because my bad, everybody. PE ratio 8.63, price to book 0.73x, payout ratio 26.29%. 5-year growth rate 44%, although it's skewed towards the earlier part of that 5-year range. They haven't increased their dividend since 2019, so that number is a goose egg today, and their yield is 3%. Interesting, Landon, do you want to talk about their stock performance recently?
Stock performance, again, right now, year to date, they're up, 6%. I feel like now people are understanding banking is undervalued. Plus, maybe it's, the Fed rate hike, so they're like, oh yeah, they'll probably be earning more, so let's see a nice little surge in banks. But the last 52 weeks, though, they're only up 4%. So again, up 6% year to date, up 4% over the last, January of 2021 to January of 2022. But again, we're sitting on a $2 trillion asset bank showing strong signs of undervaluation. Just look at that price to earnings, look at that price to book with a very low dividend payout ratio with an above average dividend yield. So Bert, you already own Citi and you're in your wife's portfolio.
Yep, yeah, my wife, I'm pulling it up right now as we speak.
So as Bert's drilling in here, again, what big bank stocks do you own? Let us know in the comments. What's top 5? Is it Wells Fargo? Is it Citi? Is it Bank of America? Is it JP Morgan? Just let us know in the comments which one you own.
All right, so I got the number here. My wife owns 32.378 shares of Citigroup, so the position's just a little above 2,000.
Get that to 5,000.
Yeah, I was going to say maybe at least 50 shares in the short term is a goal for this company.
50 shares. 50 shares.
It is signs of undervalued, and it's starting to do a little rebound. When we bought it, it was in the low 70s, and we just kept lowering our cost basis. So our cost basis is in the mid to high 60s. So hey, why not keep buying at this lower value?
Bert, can I throw out a challenge? If we get this video to 400 likes, Bert will get to 50 shares.
Yeah, my wife will, but yes. No, I'm kidding.
Well,
yes,
yeah.
I'm messing with you. But yes, absolutely. Sure, everybody, do that. And you know what? I'll get
400.
I'll get to 60 shares if you make it 500. We'll leave it there, too.
Okay, let's make sure we get over 500. Let's boost this guy's passive income stream, the dividend income stream from Citi. I would love to see the 500.
Let's do it. Well, of course. Yeah, let's do it. Let's get there, everybody. Help us out, too. One last piece of news for Citi that's going to be interesting to follow, see if it's another banking trend, is they're shedding out of their consumer business as well. They are selling off and spinning out in Mexico and Asia and Europe. So consumer, they're trying to exit out of that arena. Could it be a sign of future moves for other banks? Could it be a sign of where the economy is going? Who knows? That's not going to stop me from buying and getting her to 60 shares if you get us to 500 likes, though.
All right, guys, you heard that right here from Bert the Hurt. This is a dividend stock to buy right now. Again, we talked about the 2 smaller banks as dividend stocks to buy. Even some of the largest banks in the world are dividend stocks to buy right now. So again, please let us know in the comments if you're buying Citigroup stock, if you're buying anything in the banking industry. We want to know in the comments. If you haven't already, subscribe to our channel. Definitely smash that thumbs up button. Again, let's get to 400 to 500 plus so that Bert can round out his position on Citigroup.
You know what? The only thing I'm missing here is send us off, Lanny.
You got it. That was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.